Happy New Year, Investies. This is the first episode of 2024. In this week's episode, we are going to review how the stock market performed in 2023, and we're also going to get into some of the things that we should consider for 2024. In 2023, the stock market had an incredible performance. I want to take some time to congratulate everyone that was participating in the growth that took place via the stock market. It's amazing when we have these types of years. Not every year is a positive year, and when we do have positive years, it's important to celebrate that win. So congratulations for being one of the few folks that are actually participating. We are going to review the top 3 indexes and how they performed. The first index we're going to quickly talk about is the Dow. Now, the Dow is an index that measures the top 30 companies in the United States. These are usually older blue chip companies, which means that they have stood the test of time. The Dow is measuring the change in price from each of the shares that it has within the index. So it is a price-weighted index. Anytime that the price is changing to the upside or the downside on each of the shares, this is what the Dow is keeping track of. Mainly, investors don't necessarily like to lean on the Dow Jones for a measure of the broad stock market because it is so precise. It is mainly used to see what folks are selling in and out of. It can be an indicator of what is being sold and what is being bought if there's a change in investor behavior. Now, the typical growth on average for the Dow is 8%. In 2023, the Dow came in at 13.7%. It beat its average return of 8%. The Dow did great in its performance this year. Now let's take a look at the S&P 500. The S&P 500 measures the top 500 publicly traded companies in the United States, which also happen to be the top 500 most powerful companies globally. On average, we can expect the S&P 500 to increase by about 10%. The S&P 500 for 2023 increased by 24.73%. Absolutely incredible growth for the S&P 500 in 2023. The S&P 500 is a market capitalization weighted index, which means that it measures large companies versus the Dow Jones that measures the change in price. We use the S&P 500 to really get a grasp on how the overall stock market is performing. It does have different sectors. It actually measures all of the sectors that exist within the market. So it gives us a good understanding of not only what is taking place in the broad market, but what is taking place in each of the sectors. And last, but certainly not least, we have the NASDAQ. The NASDAQ is an index that measures mostly tech stocks. Now, there are some stocks in there that are not tech, but for the most part, this is what the NASDAQ focuses on. The return for the NASDAQ on average is about 15%. Last year in 2023, the NASDAQ was up 44.52% for the year. Absolutely incredible performance. I want you to really think about those returns on an investment. And I also want you to take into consideration how much of a return you are currently getting on your money, whether that is from having your money in a traditional savings account or having your money in a high yield savings account or having your money in any other type of investment. This is one of the reasons why I am so passionate about giving accessible education on the stock market. It's important for us to participate. You've heard me say this many times on this podcast. Only 15% of Americans are participating in the stock market. And unfortunately, those numbers dwindle when it comes to looking at Black and Brown communities' participation. This is something that I passionately believe has to change, most especially when we are high consumers of products and we are the contributing factors as to why these companies are producing high revenue and also high returns on an investment. We're going to take a short break, and when we come back, we're going to talk about what to expect in 2024. Investies, I have some important news. I have opened up enrollment for Wealth Warrior, the course. The course is set to take place on February 24th and February 25th. This is a crash course that is perfect for beginners. It's going to take place 5 hours on Saturday from 11 a.m. Central Standard Time to 4 p.m. Central Standard Time. Same time frame on Sunday. The class is virtual, it is live, and I do take questions from students. Because of the questions, it is important for me to only have a limited amount of seats available. If you want to join the course, I highly recommend that you join us on February 24th and 25th. Life has been lifing. And with all of the changes, me being a candidate for state representative unopposed, I am going through my own personal learning curves where I'm working on learning the state laws. This is taking up some of my time, and I do want to center it because it is important. And so, to be completely transparent, I do not know when or if I will ever teach this class live again. That's just the honest truth. So if you've been thinking about wanting to take this course, I highly recommend that you join us. I highly recommend that you start investing and understanding how free markets work. I love this course with all of my heart. I have poured my soul into it. It has everything I have learned in the last 11 years as an investor. It is a great beginner's course if you know absolutely nothing about the market. I look forward to seeing you on February 24th and February 25th. And we are back. We did not have a Santa Claus rally. If you remember several episodes back, I talked about a Santa Claus rally. We'll definitely link that in the show notes. If you haven't listened, definitely go take a listen. In short, the Santa Claus rally is when the stock market goes up the last 5 days in December and then the first 2 trading days in January. Trading days just means that the stock market is open. The stock market came down in those 7 days. We had no Santa Claus rally. What the Santa Claus rally tends to indicate is that we will have a positive year. Unfortunately, based on this indicator, we are showing that the year will be negative. However, there's a big caveat here. We are in an election year, and this changes the game. Statistics have shown us that on election years, the stock market tends to be positive. And when we have an election year with an incumbent, the stock market tends to be even more positive as opposed to having an election year without an incumbent. The election year statistic could potentially offset the Santa Claus rally statistic. We are in a new quarter. Happy Q1, by the way. We do have earnings season taking place this Friday, January 12th. This is going to be a very important earnings season. We're getting all the reports from Q3. This is going to give us insight on how the holidays performed, how spending went, and it is also going to give us a look at how the overall economy was affected. So it's going to be important for us to pay attention to earnings, not just for our individual investments, but also so that we can get a pulse on the overall consumer, which is the overall economy. That is my biggest concern. This is why I'm going to be paying attention to earnings really closely so that I can get a gauge on how the economy is doing. We are wanting to see the effects of interest rate hikes from 2022 and 2023. We have already begun to see some effects in Q3. We want to see if those effects are going to continue to be detrimental in Q4. So just as a reminder, during the first quarter, we get all of the earnings reports from the last quarter, which was Q4. We're going to keep you up to date with all of the news on economics, my perspective, as well as the stock market. So don't worry about that. Keep tuning into Investies. I'm your host, Linda Garcia. This is a podcast produced by Cosmic Standard and In Luz We Trust. A big thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.